how can we get more involved in businesses that can produce higher yield, right? That we can put more operational effort into and kind of leverage our networks and leverage our connections to really help grow, that all tie together in some way.
Welcome to the Fully Funded Show. Whether you're a capital raiser, deal sponsor, fund manager, or LP investor, we've got the insights you need for investing success. Join Sam Silverman each week for expert interviews, insider tips, and strategies to fully fund your ventures. Let's go!
Hey, we're back with the Fully Funded Show. This time it's a solo podcast with just myself on here today, and really wanted to discuss the types of assets and asset classes that I'm most focused on right now and likely for the foreseeable future. So my core competency investment thesis has always been tied to cash flowing real estate assets. So we've historically done deals in multifamily, short-term rentals, mobile home parks, RV campgrounds, storage, debt, and we had a really wide focus. I think right now we're really focused on three main asset classes in real estate, one in the debt space, and we're actually adding another entirely separate asset class and kind of direction here as well. So I wanted to walk you through each of the asset classes we're focusing on and why. So one, we're really heavy in the short-term rental, or think Airbnb space, for a few reasons. One, we really love the partner and kind of operation we have there. We are fully vertically integrated with TechVestor, meaning we do everything ourselves, from acquiring properties, leveraging our own technology to go acquire properties. So we feel like we have a unique advantage there. We also, everything from design, construction is done in-house. We also manage all of our own assets in terms of actually managing the guest experiences, managing the performance of the assets, revenue, OpEx, right? So we have our hands in every area, and we have full control here. We really love this asset class in the sense that all of our debt across our entire portfolio is fixed for at least 10 years. Most of our debt actually in Fund 2 is fixed for 30 years or more, right? So allowing us to have those same debt payments going forward. If we have to hold longer than that 5-year hold period that we're projecting, we have things in place to allow us to ride out any down period in the economy and the market and the asset class itself to hang on for a better future outcome. Additionally, the debt service coverage ratio hovers between 2.5 and 3x across the entire portfolio. And what that means is that for every dollar of debt that we have in terms of debt service, each month we have between $2.5 and $3 of net operating income. It's your income after all operating expenses. So really, stable, a lot of buffer in that area, really strong cash flow. The asset class is also early on, right? Other asset classes like multifamily have had institutional capital flow there for years. And this asset class has not. Institutions look at doing two things typically. One, they build, or two, they buy. And right now, building the infrastructure for the STR space, it's a lot, right? In terms of the employees you need, in terms of the technology, in terms of the people, right? It's a big lift to go do so. And you're building one property after the other. It's not as if you can go buy a portfolio that is 500 units tomorrow and go deploy a $50 million check. Other asset classes, you can go buy or build very large portfolios or properties, in a much easier, more condensed process than the STR space right now. So we feel like we have an opportunity there to go roll up our portfolios in the future to institutions looking to go buy to break into the space. So overall, it's the yield, it's the fixed rate debt, it's the ability to go perform better than the property next door. In multifamily, for example, like I'm in an apartment building right now today versus the one next door to it, maybe they can get 5, 10, 15% premiums as for rent. When looking at the STR space, you can do 50% more than the property next to you if you design it right, if you manage it right, if you create a good experience there. So huge swing in that sense we feel very confident about. Then debt, cash flow, experience, right, ability to go push revenue each time, and also pre-institution capital has kind of flowed in. Second, we're really big in debt right now. right? We actually partner on a debt fund that lends capital to single family fix and flips, right? We like that as an investment class in the sense that there's a big property shortage when looking at inventory in that, lower price to middle priced home. Think, $200,000 to $400,000 home range. So we feel like there's huge demand there right now for houses that are presentable in that area in terms of price point for the average person looking to go buy a home. And there's enough buffer room and track record of that fund itself that we feel very, very confident to use this fund as a money market account like option for both myself and investors, right? Pays a fixed monthly dividend. They have not missed a distribution in 10 plus years, right? So very, very stable in that sense as well. And a lot of buffer room for things to go wrong, where you can still pay the investors out and make sure they're made whole. Additionally, it's spread out over an entire fund of 200 plus loans going on at one time. So if one loan ever defaulted, not only are you in first position in the asset class to go take the property over and go exit it, right? There's enough buffer room in the numbers to take the property over, either fix it up yourself and or sell it, or just sell it to recoup all investor capital. So we feel very safe in that sense. Third, we are still in multifamily, right? Very selectively. We like multifamily in the sense that people still need housing, and the ratio of renting versus owning right now very heavily leans towards renting. So we feel very confident asset class going forward. We do feel as though a lot of the huge yield has been taken out of it the last few years, right? So yield has gone down. We've seen cash flow decrease. We've seen overall returns normalize, right? I think we're at a place now where we'll see some stability there going forward for deals that are being purchased now and go forward. We also see a lot of value in the smaller multifamily properties as well. Think the sub-institutional size type deals in that $3 to $10 million range that these larger companies and institutions may pass on. We feel like you're truly getting properties from sellers that don't know what the property is worth. They're unsophisticated in the sense that you can actually get a better basis on your property. And there's the one thing you can't go solve for, right? Is getting a quality basis on your property is so crucial. Lastly, we are in, and I'll kind of bunch these in one asset class, even though they are two, is the mobile home park and the RV campground space, right? Mobile home park and RV campgrounds can operate very similar if the RV campgrounds are a long-term in terms of rents, right? We have the traditional year lease there. You also will have at times kind of an STR component for the RV campgrounds as well. The reason we love this asset class so much is that in a mobile home park, when you buy it, you are typically buying a property, and you can either buy, one or the other, or a combination of both, of the property in which you own the homes on the park as the park, or the tenants own those homes as well. So something that we'll look to do at times is buying parks in which we will own the homes ourselves and actually sell those off to the tenants as well, right? Therefore, creating a lot of ownership of their home. And in turn, you're really leasing them a block to put their home on and creating a quality community around them. So you're seeing much lower vacancy, right? Typically in the sub, 5-8% turnover year after year. In apartments, that can be more in that 40 to 60% range. Meaning if you have 100 units in an apartment building, between 40 and 60 of those units each year will turn over for a new tenant. Meaning you have vacancy periods, you have turnover costs. And when looking at the mobile home park space, you maybe have between 5 and 8% in terms of turnover each year, because someone actually has to go move their home to a different place, right? They're looking at it from the longer standpoint of, I want to be an owner. I want to stay in this property for a long time. I want to take care of it. And in turn, they stay there for a very long time. There's a pride in community, a pride in ownership, which we really do appreciate. Also, from the investment standpoint of it, your operational expenses can be very low. It's very affordable housing for people in times of a downturn. And the depreciation you have can be as high as 2x relative to the purchase price of a property as multifamily apartment buildings. So if you actually go take advantage of the depreciation, whether you qualify for real estate professional status as a tax purpose to go drive your depreciation, to go use it more efficiently, or you have passive gains that you want to go help, wipe out due to depreciation, great option for you in that sense. And for us, we hold those deals far longer. We don't plan on selling them that quickly, right? We want to hang on to them, use the depreciation, operate them, refinance, pull out cash, and then really hang on to those assets long-term for cash flow and for future depreciation. When you look at the RV campground side of it, you do have a lot of those similarities to the mobile home park space outside of potentially operating some of those projects as short-term rentals. So you have more volatility when that happens. We also have far greater opportunity to go boost yield and increase cash flow. So we really see both these asset classes as tied together. And a lot of these deals that we're buying now are truly, truly off market, right? Some of these deals we are buying where the sellers kept their financial records on loose leaf paper, right? And it's an opportunity for us to go get really quality basis, go put in professional operating systems, really boost the value of those properties and cash flow for the very long term. And finally, one of the other reasons why we do love the mobile home park space is just because it's one of the few asset classes that by market can actually have negative supply, right? You'll often see apartment buildings being built, you'll see other complexes being built, but in the mobile home park space, you likely see a negative supply in terms of new units coming on board versus the units that are leaving. And that's for a few reasons. Land typically can have higher and better use for something else. You also have NIMBY laws, right? Not in my backyard, where you have certain zoning regulations where people don't want the mobile home parks near their areas. So in turn, we're seeing supply going down and down and down, making those parks and that land more valuable over time as well. And lastly, this has nothing to do with real estate in any way, even though the businesses could be actually tied to it. In real estate, for example, most property that you're buying trades on a cap rate, which to figure out the multiple of that, you would take 100 divided by the cap rate and get your multiple. So for example, if a property is a 5 cap, you would take 100 divided by 5. That property then trades for a 20x multiple on net operating income. You may see some tertiary properties or smaller units trading for 8, 9, even 10 cap, depending on the market that you're in. Even at a 10 cap, that means that asset is trading for 10x the net operating income. Let's shift gears and kind of think it from the business standpoint. Businesses you may see trade at 2, 3, 4x their EBITDA. So EBITDA works similarly to net operating income for real estate. So even on very high end of businesses, calling it say 5x of EBITDA for kind of small mid-sized businesses, that's still 2x better than your best real estate cap rate that you're going to go see, and 4x better than one of the more standard cap rates that we see across the board. So something we're looking at diving into going forward is how can we get more involved in businesses that can produce higher yield, right? That we can put more operational effort into and kind of leverage our networks and leverage our connections to really help grow, that all tie together in some way. So we're putting a big emphasis on how can we start going to both buy and invest in businesses right now that we see there's a huge opportunity in terms of rolling up businesses going forward to bring to our investor and our partner base. So hopefully that was helpful when thinking of different ways to go allocate your capital this year as to how we're thinking about it. These are all things that I'm personally investing into and diving deep in, both myself and bringing to our investors and our partners. So if you're ever curious about it, feel free to send me a note on LinkedIn. Super active on there in terms of connecting. But yeah, that's our general investment thesis for this year. And this is dated March 27th when we're recording this right now as well.
Thanks for tuning in to the Fully Funded Show. If you enjoyed today's insights, hit follow. Share with your investing pals and drop us a review. Connect with us on social media for bonus content. Your success is our mission. Keep those funds flowing. See you next time.